Okay, into the new room. Hopefully, DJ Sulan will join us shortly. Yep. Got Canisia. Wait, my calculator blanked off. Right, so I've been punched the 3 and the N, and then compute PV again. Did you get the 14,848,573? Canisia. Ah, yes, Solan's here. Excellent. So you should be able to know what to do next. So after the 14,848, oh, comma, 14,848,573. Next, we simply press 4, press N, and then compute PV and write down your new value. 14,557,425. Excellent. 14,557,425. Right. So Dan, are you okay with these? Great. So now that we have gotten through that basic bit of discounting, so that's basic discounting our financial calculator has helped us out with. So again, we could make a note to the examiner with that. So we could say we did this using the financial calculator. So that's why we didn't need to quote any discount factors. And now we can apply the formula for duration, which I don't think you are given in the exam. Let me double check. At the front here, formula sheet, where did you run away? Right, at the front of the syllabus. Nope, black shows. Oh yes, you do have modified IRR, but that is not what we are doing. We are doing modified duration, and I am not seeing that anywhere. So you will have to memorize your duration computation, which now says, again, this step 1 on page 223. Is that here in your course notes as well? Affected by maturity date, interest rate, duration, weighted average of number of years, redemption. Not really. They didn't really explain it in the best way. The computation, that is. So present value of cash flows in each time period, add them together. So that is simply this value here, totaled up. So total of PVs, add those up. A little auto sum, and I will get, look at that, 60,000, 60 million. That is very interesting. Something's up. If I add all of that back up, oh, I did not do something. Add the present value, multiply the present value of cash flows for each time period by the period, and then add them together. So yes, this first one, we know what that is. That was the initial outflow. And we need this next row here, which is PV times year number. That is the one that's going to give us something different. and taking our PV of 15 to multiply it by 1 and so on and so forth equals our PV of the 15145 times 2 and carry on. Everybody okay with this step? So effectively this is step 2 on your page 223, taking your PVs, multiplying them by your year numbers. Now add this up. So while this total of the PV is the basic starting value, what we really want is this value here, summing that auto sum there. And this 148,514,965. That is what we will now take to do our division. Divide step 2 by the result of step 1. Present value of our cash flows. So since we are paying back 60,000, or sorry, we are paying back those annual values, the sum of it would have been 60,000 that we have started with. That's the present value. And we can call this, what can we call this? Total PV times year number. All right, that's all it is, the total of the PV times year number. And you now divide. So we can say duration what's this going on here? Okay, so alrighty. Duration equals sum of PV times year number all over sum of PVs, which would now get us 148,514,965 divided by your 60 million, and somebody tell me what we get for duration. Come on, punch them in. And we ain't finished yet. This is just duration. We need the modified duration. 2.47 years. That's right, 2.475 years. Very good. So that's the amount of years which your duration is. Now, on to modified duration. Modified duration says take our macula duration and divide it by 1 plus your gross redemption yield, which is on page 224. So that's on page 224 as well as 113 of the taught course notes. And we remember reading from the question that it told us that the gross redemption yield was the same as the 2%. So just setting that in, modified duration equals duration divided by 1 plus GRY, gross redemption yield, and that gets us to our values of equal to 0.475 2. Everybody quoted 4 decimals divided by our 1.0 2 as a decimal because we know that the 2% was given as a GRY, and somebody gave me that number. Nope. We'll discuss the meanings of them just now. Can you see? So the numbers are actually different also. So it's 2.4267. Very good. 2.42. Hold on. 2.4267. All right. Let's get to their meanings now. So, duration. The regular duration measures the weighted average number of years to redemption, where the weights are the proportion to the market, the proportion of the market value recovered by the investor each year. So, regular duration is a weighted average number of years to redemption. So let's just write this up for Kinesia. Regular, or just duration, is the weighted, average number of years to redemption. I could substitute words for redemption, payback, right? So the average number of years to payback, whereas the modified duration represents something else. So modified duration predicts that linear relationship. 1% will fall by so much. Could I write that in a simpler form? What is modified duration? It's a measure of the sensitivity of the price of the bond to the change in interest rates. Yeah, that's a nice explanation. So, modified duration is a measure of the sensitivity of the price of a bond. Again, we can use substitutes for the bond. It's a loan, any type of loan as such that you calculate the duration for, to a change in the interest rate. So, what does this mean? So the Dot Course Notes has a nice example. Since our modified duration is 2.4267, then if the GRY rises by 1%, then the price of the bond loan will fall by 2.4267%. Very interesting. So therefore, I don't think that answer that we wrote for the modified duration should be given in years. Should just be a number. Proportion change for given change in the yield. Because we already took a value in years and we divided it now by 1 plus a yield. But Yeah, I guess it's still the change. It's the number of years per percentage. So it's a kind of funny figure there. Yeah, the units are a bit tricky. Years per percentage. So measures that sensitivity of the change in the bond price. And again, we don't have a bond in our question, we have a loan. So it just substituting the two words, bond for loan. All right, so is that explanation okay? Yes, can you say you're all right? Okay, right? Go ahead. Don't mix them up. Two different things. Oh, that's the first one. The first one is maculae. So duration, it's just that average, and I spelled number wrong here. It's that average, weighted average number, NUMBER. That one's maculae. So the regular duration is maculae. And it's the number of years to pay back. Now, normally I'm remembering it's supposed to be the number of years to pay back half, but let me see. Let me see if I just double check that. Some of the PVs, the average time to recover the cash flow. Yeah, so if you look at page 223, can you say it's right there? 5.1, that paragraph says, it's simply the average time to recover the cash flow from an investment which is not affected by the maturity date of the investment, but also by the coupon rate and so on. So we want to be able to compare bonds quickly, or in this case, loans. So again, it's that weighted average time to pay back. So it's very similar to payback period. It's like a payback period. So duration, maculae duration, same thing. So that's your basic duration, right? So duration, just like the word duration, duration tells you a number of time or length of time. So the duration of our first session was 40 minutes and we got bumped off. So duration speaks the time. And again, in this case, it's time to redemption or payback. And that's that. So the average time. But unlike the regular payback isn't weighted with anything. It just takes the number of years and adds the cash flow received in each year, right? So here we are both discounting, so it's closer to discounted payback. So we are both discounting as well as putting in this weighting for the number of years. So the fourth year cash flow was weighted 4 times, the third year cash flow was weighted by number 3 times, and so on and so forth. So that's those two additional elements compared to the simple payback, which is just based on the future cash flow, right? But effectively, it's a payback period, right? Whilst the modified is that ratio or proportion or sensitivity. Good. So two quite different things. Please make sure remember those and don't mix them up. Rolling up to our final part as an alternative now. Oh, sorry, that was part C. We just did that. Measure, calculate modified duration if it's repeated. Explain how duration can be used to measure the sensitivity of a loan to changes in interest rate. So we practically explain that a bit when we explain what modified duration is. Is there anything else we would want to say about that? There is the bit straight from the course notes, page 113, paragraph 5.10, 5.10, about the concept of convexity and so on, and the use of this modified duration rate. And it's only an approximation because it assumes a linear pattern, while the actual change of yield rate to cost of the loan or price of the bond. So that those two things, we shouldn't get the terms mixed up, or shouldn't get phased by the general theory or the generic theory and what we are doing. So every time the general theory says price, we could just say cost. Every time the General theory says bond, we can just say loan. So the loans come at a cost. And could somebody just indicate quickly in the chat for me, what is the cost of a loan? Something that will indicate, it's two words. Something that will tell you what a loan costs. Regular loan, like we have in our question. So the loan cost is the equivalent of the something. One word starts with I. The loan cost is equal to its something. Come on. We used it in half the calculations already for tonight. Cost of a loan is its, come on, think about cost of debt. Cost of a loan is its something. One word starts with I. The other word starts with R. Come on, ladies. The interest rate. Thank you, Kinesia. So, again, using the theory to do a bit of the explanation. So we're just saying that the only other added explanation that this sensitivity of the, again, what did the question call it? Question called it duration can be used to measure of sensitivity of the loan to changes in interest rates. That's sensitivity of the cost of the loan. And I get stick in here, interest rate, to the what of the loan to the measure of the sensitivity to the changes in price of a bond, cost of loan, so the interest rate on a loan to the changes in the interest rates. It's like the market rates is only approximate. Oh, the other word for market rates here is the gross redemption yield that we were plugging in. Market rates, or GRY, is only approximate since the real relationship between GRY and loan rates is a convex curve, while the computation of modified duration assumes there is a linear relationship between these two. Right? So that's basically the disadvantage of using a computation. But we explained already what it is. It helps you get that sensitivity. And if GRY goes up by 1, then the price of the loan will go up by that. So that's that. Complete part C. So let's try quickly to get rid of part D so that we can all go and sleep. Sleepy, very sleepy tonight. So, where are we? Part D. Right, so anybody using down here still? Yeah, I thought so. Yeah, just came back. All right, so take a look at that while I flash back at the question here. Right, part D is asking us, prepare memorandum, a discussion. Wonderful. Proposal 1 in light of the concerns and discusses the agency issues. Proposal 2 and how these can be mitigated. And that is that. So 2 wonderful discussion for 9 marks each. And we want to use the proper presentation format. for the memorandum to gain our 4 professional marks, 9 and 9, 18. All right. Good. So with this memorandum, let's try and get that out of the way. So 2 bits discusses proposal 1 in light of the concerns raised by the non-executive directors, and then agency issues related to proposal 2. So much of this now is what we overviewed straight from our section A, our agency issues. So make sure when you're reading your section A, you can go through some type of summary to deal with that, right? So that we can memorize it. Okay, excuse me. So make this a little bigger and go up to the case. So with proposal 1, treasury function, we have various issues showing up, right? And again, in proposal 1, the issues the directors are watching out for is the concerns raised by the non-executives. So proposal 1. Certain of treasury function to manage foreign currency and interest rate exposures. Treasury function will be headed by the finance director. Purchasing director initiated the idea. Opinion this would enable them to make better decisions. Finance director wants to make more money, increases remuneration, and increases influence. So is that good response? When proposals were put to non-executives, they indicate that they were broadly supportive of the second if the financial benefits outweigh the costs. However, they felt that they could not support the first, as this would reduce shareholder value because the costs related to undertaking the proposal are likely to outweigh the benefits. In addition, you had all of this other stuff. So costs versus benefit of these hedging techniques is what we want to look at, right? So we need to get to grips with format of your basic memorandum and so on and so forth. Let's see if we can start punching some stuff here. It's about the make sure you have things stated like simply memorandum. The basic stuff, to from date subject, that's not really going to get you any marks. So what they're really looking for is your introductory, your style, your writing style, and your conclusion, and making sure that you hit several of the relevant points, right? So your structure of the memo, that's what's going to get you the 4 marks, not writing these things on it up here, to from date subject. So again, it's 2. But you still need to write it. So without it, you would probably lose marks. The board of directors of CMCCO. And from, did they give you a position in this question? From, who's it from? Want you to use the following. Then I'm not seeing. They didn't really give you a title. So I guess you could just say from analyst. Right, but don't say from accountant because you're not accountants yet. Right, date, the current date, whatever it is. Today is the 19th October. Subject. So I guess the subject come in two parts, or you could probably group them together. So what we did here, discussion of the proposal. All right, so we have 10 minutes. Let's see what we could do with this proposal to manage foreign exchange and interest rate exposures and the proposal to move operations to 4 branches and consequential agency issues. Right, so again, the requirement, one of the key tricks in making sure you keep to the requirement is to keep referring back to it as frequently as you can. So we're discussing the proposal 1 in light of the concerns raised. So the concern raised started off with the, so you could list back here, it's part 1 that we're dealing with. So part 1 for proposal 1 concerns of the, what was it, non-executive directors on cost of hedging. All right, so this is where I could link back to some of the computations that we did. Excuse me. So cost of hedging would outweigh the benefits only in the perfect market scenario. Here are the assumptions of market efficiency and freely available information holds since perfect market conditions are only theoretical, then this argument is not true. Right. Hedging eliminates risk and shareholders will always be happy with this. Although I don't like the word always there. Let me take out this always. Shareholders will be happy for this when they are not well diversified in their shareholdings. Right. So if they're not well diversified, they would want that reduction of risks. What else? The volatility of the exchange rates will be of great concern, directly affecting the cash flows for the costs of the payment. Volatility will be of great sense and directly affecting the cash flows of the cost of a payment being hedged. If it's facing significant financial distress, I think I will leave that there. All right. So that. Next, other reason for active hedging. Active hedging may also reduce agency costs, since most managers are unlikely to hold well diversified portfolios. So will be or will place value on the reduction of risk. This will be what the majority shareholders are also seeking. Right? So creating that goal congruence there is that reduction of the agency cost. So other two parties could be mentioned, the bondholders as well. and then the concept of the financial manager, finance director, wanting to get a larger pay package. So we're almost required to switch to another room. So I think I'll wait for that to pop off and then go to the next paragraph. All right, so the room switch is coming up.